What's going on, wealth builders? My name's Charles Newton with Secure Harbor Financial, and in this video we're going to break down how utilizing a whole life policy is the ultimate way to growing your hard money lending business. We're going to break down the numbers, we're going to show an actual illustration, we're going to show a theoretical case study, and show how a strategy could be implemented. And it's just important to note that even though this is a certain case study, these things are very customizable. And so it's just important to speak with somebody that actually has your best interests in mind and understands the concepts that we'll be speaking about within this video. So without further ado, let's break down exactly what this strategy is all about. Here we go. We're going to use John as the example. John understands and really sees the value in implementing this strategy. Okay, so over the course of 7 years, he wants to contribute $1 million into the policy. So for each year, that's about $143,000 that he would be contributing into this policy per year for 7 years. After those 7 years, he'd no longer have to contribute any more money. It would be completely paid up, and that policy would continue to grow uninterrupted compound interest. It'd have the death benefit and all the tax advantages that these policies have. Now, the cash value in year 10 would be over $1.2 million. And what would be available for lending at that year 10 mark would be 90% of that cash value amount, which is about a little over $1.1 million that he'd have to utilize for his hard money lending business. So let's paint the picture of what it would look like if he deployed that money into his business and see the returns that he would get. All right, so let's break this down. Just as a little backstory, John is a 45-year-old male. He got a preferred rating for his policy. And in this example, we're going to show how deploying his money in year 10 for a hard money loan, what the actual profits are and the return on capital that he gets. So as you can see here, the policy loan amount is $1 million. Now, just so you guys know, the loan interest expense for the 12 months is at a 5% interest rate. So that total cost is $50,000. And he lent the money out for a total of 10 months at 12%. So that money was deployed at a 12% interest rate that he was giving to the investors. And so that total income is $100,000 for the year from his hard money business. Now, the net lending profit is $50,000, as you can see here. But that doesn't include the total picture of what happened when he utilized his whole life policy to deploy this strategy. So even though he pulled out that $1 million from his whole life policy, the cash value growth continued to grow as if he never pulled out that $1 million. And it grew by $52,311. So let's see what the actual net profit is for this year in year 10. All right, so as we can see right here, his return on capital and his total profit in year 10 is $102,311. How do we get that? It was the $50,000 net profit plus the $52,311 cash value growth, equaling a total profit of $102,000. His return percentage is 10.23% on invested capital. Now, we want to make sure that we're including what life insurance does, and utilizing a whole life policy does for us as well, is no matter what, we're going to win in the end. He's got a death benefit in year 10 of $2,120,000 that will go to his estate, that will go to the people that he loves the most. Let's face it, guys. If you're in the hard money lending game, you're a sophisticated investor, and most likely your net worth is much higher than the average person. So you're already baking in, a much more efficient way to transfer your estate when you're utilizing this whole life policy. This is a holistic approach. But let's dive in deeper here. Let's go to the next stage. Let's see what it looks like deploying the exact same strategy in year 20, how the return on invested money gets better and better and better. So here's the hard money loan example in year 20. Same $1 million, same 5% interest rate, same income deployed for 10 months that he gets from lending out the money for 10 months, which is $100,000. Same net lending profit is $50,000. But let's take a look at the cash value growth right here. In year 20, the cash value growth grows by $77,476. So let's see what that actually does. What we see here is we have a return on capital total profit in year 20 of $127,476 and a return percentage at 12.74%. The death benefit has grown to $2.7 million in year 20. So think about all the different variables when you're utilizing the policy. The policy itself is not going to make you rich, but implementing the strategy in your life, in your hard money business, is going to make everything better. You're going to have the death benefit. You're going to have better returns on your capital. Your money's going to be protected. The cash value growth is going to grow tax advantaged. It's an incredible strategy. What we're going to do next is dive into the actual illustration so we can understand and see how these policies perform on a predictable basis, unlike investing your money in the stock market. So let's hop right in and see what that looks like. All right, so let's break down this illustration of this actual whole life policy. So in this case, you can see that John has been contributing $142,857 a year for 7 years. That totals $1 million over the course of that 7 years. Now, there's a couple things that I want you guys to be aware of. When you're looking at a whole life insurance policy, there's going to be a guaranteed side and a non-guaranteed side. The guaranteed side is no matter what, states that this is what the insurance company is obligated to fulfill. Now, on the non-guaranteed side, it's important to understand that this is associated with the dividends. Now, being that we only work with mutually participating whole life insurance companies, you are in fact an owner of the policy and therefore entitled to the profits of the company. So therefore, the company gives you a dividend payment. Now, this company that we're showing with this illustration has been around for 115 years, and over the course of its history, it's never missed a dividend payment, which I think is huge. So that being said, right now we're at a very low interest rate environment, or we have been historically in a very low interest rate environment, and it wasn't until recently that we've had this uptick in interest rates and prime interest rates. Now, what that means for insurance companies is it means that these companies are illustrating this value, their dividend side value, at a very low rate. There's being that our interest rates are higher, the longer they stay higher, the more likely it is for the insurance companies to give you a better return than is what is actually illustrated right now. So I personally believe that in the future, there's a strong inclination that whatever is shown here on this non-guaranteed side will perform even better. But, just to be 100% clear, the future will tell what that will be. Anyways, so let's break this down. Let's break down how this illustration works. So as we see, we've contributed the $1 million over the 7 years here. And then on this side, you can see the net cash value. Now, one of the things that a lot of people have problems with whole life insurance is that the early liquidity isn't good. And that's true for improperly designed policies. But this policy, we've designed it for a hard money lender. So the early cash value, the early liquidity is at right around 91, 92% liquidity that you have access to within that first year. Now, if you look here at this green highlighted marker right here, this shows the break-even point of the policy. So, and this is between years 3 and 4 is the break-even point. So, John has contributed about $570,000, and it shows here that we've already exceeded how much premium we put in. So the cash value will always be more than the premium after this point, which is an incredibly efficient policy. It just continues to grow after that on an uninterrupted compound basis. Here's where our example comes into play. So this is the year 10 mark. At the year 10 mark, we have a net cash value of $1,237,000. And then we have a death benefit of $2.1 million. And this is the dividend, the cash value increase, the $52,310 of cash value increase. I also want to illustrate year 20, exactly where we got our numbers from. So here we have a net cash value of just under 1.9 million and a death benefit of 2.7. And then our cash value increase, the dividend payment is $77,000 in this example. Now let's dive into how flexible these policies are, because that's important. There's a lot of people that say that whole life policies aren't flexible, and that's just a downright lie. Let me show you how flexible these policies are. So the minimum that you'd actually have to fund this policy for it to stay in force is a little over $13,000 for the course of those 7 years. Now, it is important to note that when you fund them at such a low level, you're not going to see the cash value, you're not going to see the death benefit the way that it's illustrated in the policy. So, but it's just important to know that you can keep this policy alive and in force, and you have that flexibility. So now that we know what the minimum is, let's find out what the maximum is. So the maximum that we can fund this policy, according to the 7-pay, is $163,000 a year for the first 7 years. So that's a maximum we can put into this policy. That's over almost $150,000 difference in how much you can fund this policy. All right, so now, last but not least, I want to dive into the internal rate of return that we have here. So a lot of people ask, well, what's the internal rate of return of a whole life policy? And I just want to preface this by saying that utilizing a whole life policy is an amazing alternative to utilizing a bank account. So if you compare this to an investment, it doesn't look all that attractive. But when you compare it to a bank account, even if you compare it to a money market account, and I challenge you guys to average out what a money market account averages compared to a whole life policy, the dividends of a whole life policy, the whole life policy is going to knock the socks off of that money market comparison. So in the first 10 years, the internal rate of return, according to the non-guaranteed side of this illustration, is a little over just right at 3.1%. At 20 years, the internal rate of return gets up to 3.8%. And at 30 years of the policy being in force, the internal rate of return is 3.93%. Now, we would be doing a disservice if we didn't include the internal rate of return of the death benefit. And just so you guys know, there's an inverse relationship there. So in the beginning, you have an amazing internal rate of return towards your death benefit, and the cash value doesn't look as attractive, but over time, the cash value gets better and the death benefit gets worse. So I'm going to illustrate that right here. So at year 10, the internal rate of return of the death benefit is 10.99%. At year 20, it's 6.08%. And at year 30, it's 4.8% internal rate of return. So understanding those different factors will help you make a better decision. But overall, when you're making a decision like this, it's important to encompass the death benefit, the cash value, the growth, the creditor protection that you get within these policies, the tax advantage money that you get from the cash value of the policy, and then just the fact that you're protecting your family and your money is working in more than one way is such a huge way to approach this whole process. So if you found this valuable, I hope you guys would be kind enough to give a like and maybe a comment, or maybe if you have any questions, please comment and let me know what you're thinking, or if you want any clarification with anything. Also, if you're an aspiring hard money lender, or you're already a seasoned hard money lender looking to have that competitive edge with your business and you want to amplify the business, I'd be happy to hop on a discovery call with you and just see if this strategy might be right for you. But I appreciate you guys watching. I appreciate the support, and I hope to help you guys out and provide more value for you in the future.